So now, it is my pleasure to introduce our keynotes. Andrew Goldberg is the Global Head of Market and Asset Class Strategy at JPMorgan, where he oversees a team of strategists responsible for delivering a comprehensive vision for the firm's macro, market, and investment views for his clients. He is also a member of the firm's Capital Markets Investment Group and the Global Markets Council. He is joined by Stephanie Roth, Senior Markets Economist for Global Wealth Management at JPMorgan. In this role, Stephanie drives the macro outlook through economic and quantitative analysis with a particular focus on business cycle dynamics and the impact of China and the global economy. I'm excited for this presentation because Andrew and Stephanie are going to focus on the government's power during a crisis, health or otherwise, and the dynamics at play in New Jersey's economy and the interplay between all of these trends on both a national and state stage. So without further ado, let me please welcome Andrew and Stephanie to the stage.
Thank you, guys.
Thank you.
Sorry, you didn't have to, I didn't realize it was going to be such a fuss. Also, where's my blue M&Ms? Well, thank you all so much for having us, and congratulations to all the award winners. Skip, happy birthday. Yeah, 21's a big one. So we'll link up later. Just to give you a quick bit of perspective on where Stephanie and I sit within JPMorgan. Stephanie and I both work together within the JPMorgan Private Bank. JPMorgan caters to the entire wealth spectrum when we offer financial services, and it's ultimately wealth management. In the private bank, so by the way, if you go, there's something like 4,500 Chase branches throughout the country. In those branches, we have about 5,000 financial advisors that sit across those branches. And so in those branches, they cater to, call it like the mass affluent. In the private bank, we bank something in the neighborhood of 50% of the world's billionaires. And I run a team that basically puts together our views on the markets and the economy, although it's not really my view. I get to work on the team. It's really Stephanie's view. Stephanie's basically by the way, what's funny? Compliance doesn't let us say the word expert, but like I feel like none of our compliance people are here today, but like, because there's like all these rules, but like the best financial modeler and data statistician that we have is Stephanie Roth. And so originally I said, yeah, I'd love to do this presentation. Once I found out it was more about the great state of New Jersey and that we wanted to dig more into the economy in New Jersey and the interplay between New Jersey and the broader US economy, I was like, I need help. And so the first person I called was Stephanie. So Stephanie's gonna be the star of the show. I'm just gonna ask her questions and we're gonna have a conversation, but I'll say one last thing before we get into it. We're nervous. So this room is full of business leaders from the state of New Jersey and esteemed legislators, as we just saw. And so we're very nervous because some of the topics that we're gonna talk about today, they're like politically charged. Like there's no way of talking about COVID and the COVID recovery in the country or in the state without like bumping up against, stuff that's gonna feel like you're gonna feel like one way or another about it. And, now Stephanie and I don't care about the politics of this. She's a statistician. She actually is a cyborg and has no emotions. So it's just about, so that said, I would invite you, if you have a burning question or if you want to challenge one of our assumptions, I'm comfortable with you just kind of shouting it out. But we are trying to get to the heart of the matter here. So to us, it's more about the data, what the data is telling us. And hopefully our goal, I think, is to leave you with something to think about as a business community and as a legislative community, as you go back and think this stuff through. So is that fair, Stephanie?
Yeah, absolutely.
Okay, cool. All right, so let's dive in. First, we're gonna start with some high-level stuff. This is a picture of two economic recoveries. The first one, which is like the long, like the kind of longer line. By the way, sorry for the folks on that side of the room. That's like, one time I got tickets to a concert at Madison Square Garden, and it was the front row. But the way they had the place set up, it was like the front row to like the wrong side of the thing. And so, yeah, so I don't know. Hi. So that long recovery, that's what the global financial crisis and then the subsequent recovery. And then like then you see the COVID recession and recovery. Why is it shaped like that? Like, why is one so stretched out and then the COVID recovery is like this real quick V-shaped thing? What's going on there?
I think people forget that this recovery was really fast. When you compare that to what we saw after the Great Financial Crisis, it was a really, really slow and drawn-out recovery, and a lot of that had to do with the very slow employment picture. So we're all complaining about inflation, and goods prices are up, autos prices in particular are up in a big way. But we're forgetting that what caused this was really strong recovery. And of course, it wasn't entirely even, and we'll get into that a little bit. There's some dynamics between certain states and policies, but generally speaking, the recovery has been very robust. And that's what's driving a lot of what we're seeing in terms of the inflation dynamics in particular. It looks almost like a natural disaster to some extent. It wasn't a more traditional recession where a lot of businesses go under. A lot of that has to do with the policies and the fiscal support that was put into the economy. That helped in a big, big way. And that's a reason why the recovery has actually been fairly quick, at least when you compare it to other recoveries that we've seen.
Yeah, one of the things I remember in my bio, which it's always weird when we read those bios because I wrote it, so it's like I can put anything in there. But we have this investment committee that meet, a few of them, but one that meets once a week. And in that one of the things that Stephanie would kind of raise a lot is in a normal economic cycle, when the big recession comes, especially in something like the global financial crisis, there's usually some big underlying imbalance. Like there's something out of whack in the economy. So in the financial crisis, so leading up to that, there's this huge, credit was out of whack in the economy. There was too much credit extended to too many people, and that took a long time to unwind. If you go to the crisis before that, like in 1999, 2000, the economy wasn't so much out of whack, but it was the financial markets. Going into COVID, the economy was kind of in balance. Consumers were fine. They had just spent 10 years recovering from the global financial crisis. So I like that. I hate to think of it that way, but from an economic standpoint, the idea that this was a natural disaster. We had to kind of hit pause, close the economy, so you get this V-shaped recovery. But it hasn't been even, to your point, and there's been some weird stuff going on. So we'll dig into that. You mentioned inflation. When you shut down the economy, right, and then you turn it back on, all kinds of weird stuff happens. What are we looking at on this? I don't know if you can see it from where you are. You made the chart.
I made the chart, so I remember what it looks like.
Yeah,
anyway.
what are we looking at here, and what's going on with inflation? And I know that we already spoke with a couple of guests. We have some questions on inflation that we already know of in advance. So what's going on with inflation?
So I think we have to remember is this tends to be a service-driven economy. And during the pandemic, it was actually sort of the opposite, in which case the demand for goods really rose in a big way. Now, that's sort of unusual for this economy, and that created a little bit of tension and friction within the system. And that's okay that sort of happens. The economy will eventually normalize itself out. But right now, we're just in a period of a bit of an imbalance in the sense of goods demand is incredibly strong. I certainly know I have tons of Amazon packages at my doorstep every single day. And I think that's been a trend throughout the course of the pandemic. Goods spending is up about 15% since the pandemic started, and service spending is roughly flat to where it was. So that recovery is a bit unusual, and it resulted in a lot of goods coming through sort of a small garden hose. And that garden hose was largely located in Asia. So all of the goods demand has been coming from one spot, and it just created a lot of friction along the way. And that's one reason why we have issues at the ports. And the container ships are just waiting outside to be unloaded, and that's just causing a whole host of issues. But keep in mind, eventually this will sort of normalize, and the inflation pressures that are driven by goods will eventually fade.
The Fed keeps calling inflation, what's the buzzword that they
transitory.
Yeah, transitory, which means temporary. It's not going to last, right? But once you say something's transitory or temporary 50,000 times in a row, people start to be like, is this permanently transitory? Or so that's a big debate. Why do you have any faith that it's transitory, or what would we point to suggest that this bottleneck will alleviate? It just seems like the Fed's been talking about transitory for a while, and there's still inflation pressure here.
I know what's interesting about the term transitory is there was never a proper definition of it. Everybody's view of transitory is slightly different. So I would say
everything's transitory. I'm not going to live forever.
Right, everything's transitory to some extent.
I'm transitory.
But the goods side of the inflation picture should very much fade, and we have a lot of confidence in that. A couple reasons are that one, supply generally tends to meet up with demand. We know what the issues are. We just have to sort of resolve them along the way.
Remember this one?
Yep. There's a couple of issues that will eventually fade. We're starting to see shipping prices come down. You're starting to see the ports get a little bit less backlogged. Potentially, we'll have to wait until after the holiday shopping season. That causes some issues in and of itself. And then cars are a big impact. The chart before showed that cars are driving about 1 percentage point increase in that acceleration in CPI. So that should reverse.
So what's shown on this page? Because I know that you highlighted motor vehicles there. Like, what's that chart show? It says real spending growth in blue, that's down, and then price change up. What's going on there?
Exactly. So a lot of people are worried, oh my gosh, this acceleration in inflation is going to crimp out demand and nobody's going to shop anymore. That's not the case. U.S. consumers continue to want to shop. And that's basically what this chart is showing. Across most categories, yes, prices are up, but real spending is actually up more than what you're seeing in terms of prices. All of that is except for motor vehicles. Motor vehicles have seen an incredible acceleration in prices, and that has actually destroyed some demand. So that's one particular component where you could use that term stagflation, but that's not the case for the broad economy.
Yeah, and we know, and you guys know this, but somewhere in the auto ecosystem, there's a big shortage of semiconductors. Cars have 20 computers in them. Any view, or do we have a view on when that should be getting better? Because I know that different companies, even Ford is getting into the semiconductor production business. Do we have any view on when we should anticipate that getting better?
Yeah, you're starting to see some of the motor vehicles companies say that the semi-chip shortage is getting a little bit better, so that's certainly a good sign. And it depends on what type of chip. Lower cost chips are actually coming online a little bit sooner. So I would say over the next 6 months, we should see things look a lot better than they are today.
And then one more thing before I move on from this slide, speaking of autos, you shared a stat about inflation in one of our investment committee meetings that kind of got everybody to say, because we were having this transitory forever debate. You gave a stat about all else equal, if auto prices at these very elevated levels stayed the same. What was that stat? Do you remember? Do you know what I'm talking about?
Yep.
Okay,
so if auto
good.
prices
Otherwise
stay,
I was going to have to make it up. Good.
If auto prices stay just where they are, and meanwhile they're up 40% from where they were pre-pandemic. I know my car lease has been contacting me over and over again because they want to buy back my car for me.
Yeah,
I've half considered that.
Yeah.
But generally speaking, if motor vehicles stay just where they are, they don't increase further, that in and of itself would put 1 percentage point downward pressure on CPI, which would offset all of the acceleration you're seeing from the shelter sector.
So in other words, inflation's measured in terms of change year over year. So it's already up. If for the next 12 months it stays exactly where it is, that's no inflation on a year over year basis going forward for autos. We think it's hard to see from here going forward how auto prices move too much higher from here now that bottlenecks are alleviating. So some of the air is going to start to come out of like the pressure cooker. I don't know if that's like mixing metaphors too much, but like on the inflation side of things next year, that's important. Let's shift gears. I think we're going to talk a little bit about the pandemic. One of the things that we stumbled upon when we were putting this presentation together is that, and someone alluded to it up on stage when there was a podium here, there is a trade-off that policymakers had to make. I don't know if they knew they were making the trade-off in the heat of the moment, but between basically doing what you have to do to protect the community in a global pandemic. This is new, like this is my first global pandemic. I don't know about yours. But, versus what happens in the economy. So there's a lot to look at here. You're not going to be able to like pick it apart from where you're sitting, but just stylistically, generally, what are we seeing on this page? There's blue lines and dotted lines. Like, what are we looking at? Can you even see it from here?
Exactly. The main point here is that there was a decision for policymakers. Do they want to protect public health or sort of save the economy? And of course, it's not always that clear cut. But generally speaking, certain states made the decision to be more severe in terms of COVID restrictions, recognizing that, yes, there would be a more significant impact on it from an economic perspective. And
of course, the hope is like if you protect the community now, the economy will be better in the future as a result, I think was the thinking. So there's a blue line, like let me just pick like a chart somewhere, like on the top left-hand chart, there's like a blue line, and then there's a dotted line that's lower than that. What do those lines mean?
Exactly. So basically, maybe let's go to the bottom left one. It shows the deaths. So basically,
deaths.
Yes. So the blue line shows with more significant or with less significant restrictions, you're going to have a higher death rate. And if you do a lot of restrictions, that death rate will be significantly lower. And then if you move one chart to the right of that, that shows the impact on consumption. And the tides are changed in that sense, where the more significant restrictions result in a changing in terms of consumption. So more significant restrictions result in more significant impact on consumption, and then the opposite.
Yeah, this is where it's way easier to be a JPMorgan economist sitting in the comfort of, for a long time we were at home, and we stood kind of in awe of the tough decisions that policymakers and businesses had to make.
Yeah.
Right? Should the litmus test be protect human life and health and safety at all costs, or something else? That's tough. So we're very keenly aware of those trade-offs, those tough decisions. Let's dig into this deeper. This sort of gets a little controversial, I think. State by state, okay, things were different state by state. And look, in our view, there's no right or wrong. It's just there's a reality that's worth digesting as we think about policy going forward and why economies are behaving the way that they are. So what are we seeing on the left-hand side? Tell me what you want to tell me about this stuff.
Sure. So this is a measure of economic activity. And basically what you see is certain states are actually below where they were pre-pandemic, and certain states have actually exceeded that.
Okay, so that horizontal line is back to zero.
Back to zero.
Okay.
So states like New York and New Jersey are below that line. States like Texas and Arizona are above that line. So that you're seeing a sort of a more rapid recovery in some of the states rather than others. A lot of that is tied to some of the COVID restrictions that were put in place. Of course, now is sort of the opportunity for that recovery to sort of more even out. But that's sort of what we're sitting here today recognizing, that there are some states that have fully recovered from the pandemic and other states that are still sort of earlier in their stages of recovery.
Okay, and do you remember what's on the right-hand side over there?
Yeah, that's similar concept, but just related to shelter prices. You're also seeing similar divergences between states. So prices in Arizona have accelerated in a big way, and prices in New Jersey and New York are just sort of starting to recover.
Okay, got it. Let me see what's next before. So this looks like federal unemployment benefits. What are we seeing here?
Sure, this is just a picture of the employment recovery. Similar concept here, where some states saw a more rapid recovery in the employment picture, and other states are sort of still recovering. And this is the percent change in employment from their pre-COVID level. Something that we also noticed that was very clear in the data was the impact of unemployment benefits on the employment recovery. So unemployment benefits were, important and relevant for a lot of reasons, but that did hold back the recovery to some extent in the employment picture. So states that were more generous in terms of the unemployment benefits, remember, some of them canceled the unemployment benefits earlier this year, and then other states canceled them around September 5th, around Labor Day.
Yeah, and what's interesting to me, I didn't know this, so states had the power in some cases to cancel federal unemployment benefits.
Exactly, so the extra, say, $300 that was being offered. And that really changed the incentives for certain people. Some people were being paid, especially at the lower end workers, they were being paid about 30% more to stay at home than to go into work. And of course, the decision was that they wanted people to sort of stay at home and help to reduce the transmission of COVID, so that was for legitimate reasons. But it did keep those people back from the labor market to some extent. So now we're just sitting here, we recognize that and that chart actually shows 16 of the 18 states that are seeing the weakest employment recoveries all kept the benefits as long as possible, up to that Labor Day period.
Are there other reasons why people stayed out of the labor force? I know that the key cohort, perhaps, that was disproportionately affected by COVID and employment was women. So labor force participation for women collapsed initially, and presumably that's a childcare related issue, right? Is that changing?
We think it's starting to change, and there's a couple of groups that we noticed that really sort of fell out of the labor force to some extent as a result of the pandemic. So there were the people who were being paid more in unemployment benefits than they would previously. That was about 2.7 million people, and this is globally, this is not just US, of course. Then there's the people who were retired early. They're probably not going to come back. And then there's a cohort of people who are women in particular, who cited childcare as an important sort of reason as to why they're not in the labor force. We're now starting to see the dynamics change a little bit, and this is a really key inflection point in terms of when these employment dynamics may actually start shifting. And what really matters for businesses to some extent is this is really pressuring wages. So you're seeing significant wage pressures, and in that book that was on the table in front of all of you,
I forgot to bring that up. It's page 24, I think. 21 or 24. That's a really well-produced book, by the way, whoever did that. Because on page 24 or 21, I forget which one, there's a survey about, what did it say? Yeah, the one on the left.
Right,
What's it say? What's the bottom
It goes
row on that
taxes.
chart say? Oh, that's taxes. Sorry, we're talking about a different page. We'll get there. We'll talk about, don't worry. At every one of our presentations, there's usually a fist fight after when we talk about taxes, so we'll get there.
But a lot of the survey questions related to wage pressures, and that's really hurting certain businesses because wage pressures are picking up in a big way. And a lot of that has to do with certain one-time factors that we do think are likely changing around this point. So that some of those acute wage pressures should start getting a little bit better.
Quick point. On the extended employment benefits, they're all over now, right?
Yep.
You had mentioned, and I don't know if you have a slide on this or if Stephanie has a view on when people should start to come back to the labor force. Can you just talk through, like what that setup looks like a little bit?
Yep. Let's go ahead one slide.
One slide. Is this it?
Maybe let's go ahead one more slide.
One more.
Okay, perfect. So these are the key categories of people who have sort of been kept out of the labor force to some extent.
So it's age groupings on the bottom.
Exactly. So age groupings and then male versus female. So what's
real
really
quick. So male is the darker colored line and female is the lighter green.
Exactly.
The much more fashionable shade of green. And then on the bottom, just so you can see, if you can't see from where you're sitting, in the call-out box that Stephanie circled, starting from left to right, you have like the younger ages, age 20 to 24, 25 to 34, going all the way over to 45 to 54 is within that box.
Exactly. So that's sort of what we call the working age population. Those are like the real cohort of people that are generally working, and their participation tends to be very high in the labor force.
It's like the prime working age.
Exactly. So
no offense, that's what the statistician, that's what the Bureau of Labor Statistics call it, not me. Right.
So anyway, so this shows the change in participation since the pandemic started. And what you see is a disproportionate impact on female workers rather than male workers. There has been an impact across the board, but it has been more significant for female workers, particularly at that lower end of that range. A lot of work has been cited that childcare responsibilities is an important reason. And we're now just sitting here, school just started a couple months ago, so now could be a really important inflection point, in which case people who are dealing with childcare responsibilities associated with the pandemic might actually start feeling more comfortable going back to work, especially if we didn't really know how school would go back in session and if it would go okay. So now might actually be a point where people might actually begin to sort of look for jobs and recognize that the recovery is sort of continuing.
And you had also measured a little bit, around how much money do people have, in their accounts, and so they've got a little bit of a cushion right now?
They have a little bit of a cushion. So we can go ahead a couple slides, I think two slides.
Oh, I just want to see what that one is. Okay, we don't need that. This one.
Okay, so there's this one, and then the next one's going to be important too. So this one shows on the right-hand side of this page, you're starting to see the labor force naturally just sort of try to attract this female workforce, and that's by wages. So wages for female workers have increased pretty substantially, at least relative to male workers.
About time.
Exactly, it's about time. So this is sort of the labor market naturally trying to attract these workers, and at some point this should hopefully start to kick in. So the combination of the pandemic getting better, although of course we have the Omicron variant sort of creeping up, but generally speaking, over the next couple of months, with vaccines, rollout continuing and all of that, you should start to see the benefits of wages picking up, schools going back in session, start to lure these workers back. There's also that cohort of people that I mentioned that were being paid more to stay at home than to go to work. And maybe let's go to the next slide. Actually, so when you look at the impact of people who really feel good about their jobs, and those people are ones who tend to quit more often because they feel like I can quit my job and get a new one very easily. That tends to be at the lower end.
So they're feeling good about like their job prospects.
Exactly.
Right, okay.
They feel like, okay, if I quit my job, I can probably leave for another one and get paid even more. And you see that happening more at the lower end workers than sort of any other category. So this chart shows their average wage on the bottom, and the top shows the quits rate, or the sort of rate of quits for people by industry. And it's a downward sloping line showing that at the lower end workers, those are the people that are quitting more. So that tells us there is some impact at the lower end workers in particular, which is why restaurants and other leisure companies are having issues within hiring, because this is where the acute pressure is actually the worst. Now the question is, Well, when are these people going to go back? Now, employment benefits have run out. Shouldn't they show up looking for a job in October? Well, maybe not necessarily so soon, because there is some cash that has been collected throughout the course of the pandemic. Either it was because of stimulus checks that went out, saved unemployment benefits, might have been just reduction in sort of day-to-day spending because we were all sort of cooped up for a while. So the question is, how much do these people actually have saved up? Because that might give us a timeline in terms of when is everyone going to go back to work. Let's go to the next slide. So here we actually aggregated the savings that have been accumulated on balance sheets. So a lot of it has been sort of...
I want to see this slide up close. You sent it to me earlier. I'm going to find it right now.
A lot of it has been concentrated at the upper end worker. So that cohort is less likely to sort of be impacted by the amount of savings just because it's probably went into financial assets. So what really matters is for the bottom 80%, say, of income earners, how much cash do they actually have saved up? Because that will give us a sense of how long can people sit and sort of wait before they find a job. And when we actually dug into the numbers, it tells you there's a couple of months, so somewhere between 1 to 3 months worth of income has been saved up in excess of what sort of typical savings have been pre-pandemic. So that suggests that people can have a couple of months to find a job that they really like or find a job that will pay them better. But it doesn't suggest people can sit on their couches for many, many months and just live off the savings that they've accumulated, because it's not all that much, which from an economic perspective is actually sort of a good thing, because you want people to be incentivized to go back to work, because that will sort of facilitate a healthy economy.
So let me try to summarize. So I remember over the summer watching news stories about how, for example, like at the Jersey Shore, it was really tough for the boardwalk businesses because you couldn't find workers. Stephanie is saying that some of the lower wage workers, for a few different reasons. One, they've got a little bit of saved up cash. You know, they were still getting, you know, unemployment benefits, things like that. By the way, maybe people just didn't feel safe going back in. Maybe for women, they were still burdened with disproportionate childcare responsibilities, something like that. The benefits have ended. And we still haven't seen the boost yet in people coming back into the labor force. And so you've got this garden hose problem where you've got a bit of a bottleneck in the supply of labor. There's wage pressure. There's inflation coming through in the system. And what Stephanie is telling you is pretty profound, which is that if you just give it 3 to 6 months, you're going to see a squeeze where people start to run out of that money that they've saved up a little bit. They don't feel like an emergency pressure today to go out there and get a job. But if you look out there, there's a record high level of job openings in the country. People feel like generally pretty good that they can go and get that job. And you say that's coming. If you're right, we should see an alleviation of some of that inflation pressure. That's a really big fundamental pillar of our outlook. Like you can't, you know, you're either in the inflation is transitory and we're going to be okay camp, or you're not. So I think you know where we are. Before I move on here, what are some risks to, like, is there anything that can make you wrong, or like people just say, like, you know what, I'm not going back to work. I'm just going to live my life in the metaverse or whatever that is. Like, what can make you wrong?
Yeah, I think it would be if there were structural changes. Say women decide, you know, the women that have fallen out of the labor force decide, you know, I actually just want to stay at home with my family and I don't want to go back to work. It's hard as an economist to sort of get into everybody's minds and really understand that. So like we can take a data perspective.
You can't predict the future? Well, what are you doing here? No,
it's hard to sort of, the supply side of the economy in particular is hard to estimate to some extent, because there's not models for that necessarily. It's not as if I can run a regression and get a sense of exactly how these people are going to fall. This is a decision on the part of many different people, individual actors throughout sort of the economy. So our best guess is that the incentives are significant, such that now the financial incentives are actually more attractive for people to go back to work. But of course, we could be wrong there. And I think that would be a key reason.
So the economic forces would suggest that people will come back and help and alleviate the bottleneck. Okay, here's some controversial stuff. I'll let you do the talking here. So to orient us first with what we're looking at. So there's bars and then there's dots. What are the bars?
Sure, the bars are the marginal tax rates by state, and then the dots are the change since 2015. So something that we noticed throughout the course of the pandemic is that people left states that tended to be higher tax rates and went to states that are lower tax rates. And of course, there's a whole host of reasons. Moving from here to down south might be one for better weather, but we did tend to notice a trend where there was the migration sort of followed lower tax states. So I think that's important just to highlight that, New Jersey in particular is on the higher end of that, and tax rates have gone up over the past couple of years.
Okay. So net, if all of a sudden there's a global pandemic and I don't have to go physically to the office anymore, and by the way, it's really cold and I'm thinking about what to do next, it's not as much of a barrier to say, I'm going to move to a warmer state with lower taxes right now.
Exactly.
Something to think about.
So we saw that to some extent.
Okay.
And of course, I think there's been a surprise that the world sort of has started to normalize quicker than we thought. So we might see a migration in the opposite direction, but that is what we've sort of observed over the past year and a half.
Yeah, I mean, a lot of people from New York, a lot of New Yorkers left. They went to Florida and then realized when they got there, they're like, I'm going to go back. So we have seen some people coming back. This is another, who is this, the Tax Policy Center?
Yes.
Okay. Is the Tax Policy Center totally bipartisan, or how do we think of them?
I would say they're slightly right-leaning, but this is some analysis they did showing, they created a business tax climate index, and then they showed sort of the migration throughout the course of the pandemic. And you do see a relationship between...
So real quick, what's on the left? What's blue?
On the left shows the... blue is a sort of better ranked tax environment, and a dark gray is a sort of lower ranked tax environment. And what you saw is the migration from that, so the blue on the left corresponds with the green on the right, meaning people from the tax-friendlier states tended to move towards the states that were green on the right-hand side, partially related to tax reasons, although of course there's a host of reasons as to why people.
Can I just do a quick show? Is this like 10 minutes, thanks. Is this like controversial, like people leaving from a high tax state and moving to a lower tax state? Controversial, not controversial? Someone shout it out. What do you think? Expected? Okay. So one of the questions that we try to think about is and I would draw your attention to, I'd love to find a systematic way of following up and sending you a paper. We have a gentleman by the name of Michael Semblist at JPMorgan. He's the chairman of all market strategy for the whole firm. He does a lot of work for Jamie Dimon. He does a lot of work for the federal government when they ask for JPMorgan's opinion. And he's been writing a series of papers over the years about state and local finances. And this is one of the key questions that he raises. By the way, we're talking about taxes in isolation. We're not talking about education. We're not talking about, so just to take it with a pinch of salt. But from a consumer or a business's perspective, this is one of those big levers, of course, that, that we think about. What's on this one? Do you remember? I know it's hard to see from where you're sitting.
So this is not related to house prices, or at least
right
housing market to some extent. So on the left-hand side of this page, you actually did see pretty solid price appreciation in terms of property, and maybe you sort of feel that in your own sort of individual hometowns. Prices did appreciate pretty significantly across the board. You are seeing a mix, which is the right-hand side in terms of sales. So even though prices appreciated, the sort of transmission to home sales actually has been a bit more mixed. Some of that might be related to inventory issues. So there's too little inventory given the demand that we're seeing. And that does suggest that the housing market should actually be fairly solid for years to come, because there are a lot of household formations that you're seeing. There's an incredible demand for housing. And some of that just means we need to sort of restock the housing. And that might just be a trend that might persist for the next couple of years.
Yeah, we also so if you look at the chart on the left-hand side, it looks like New Jersey's marginally outperformed the United States from a home price appreciation perspective. On the right-hand side, change in homes sold over the last couple of years. Trenton's on fire. That's interesting to see. But that, generally speaking, bodes well for home builders. That's something that we're looking at. By the way, the other thing that's interesting about home building in the United States, there's a huge multiplier effect, more than almost any other industry. For every dollar that gets spent on a new home, there's something like $3 additional get created in the economy, because once you buy a home, you have to hire whether it's someone to take care of your landscaping, and you need a couch, which is going to take over a year, by the way. I could tell you from firsthand experience, whatever. So, and so we think that New Jersey is well positioned from that perspective in terms of the housing recovery. So that's good for y'all. What are we seeing here?
Here we just took a quick look at some of the industries that are most important to New Jersey, just to get a sense of.
Just real quick, but is it the chart is at the national level?
Yep.
But there are industries that are important to New Jersey. Sorry, I just want to make that point.
Exactly. So it's a U.S. chart, but we just pulled out the industries that are sort of most important to New Jersey, just to get a sense of how are those industries recovering, and they're actually recovering fairly well. So we're looking at financial services, transportation, logistics, and life sciences. Generally speaking, they're above the sort of trend of GDP growth, which is good to see. So the service sector, which is not featured on the chart, is sort of one area that's sort of dragging down the recovery to some extent.
Yeah, so it looks like the line at the bottom is truck transportation, but then you've got scientific and technical services is like the red line that, and then like the top two lines, finance and insurance, sorry for looking down and reading, but also warehouse and storage. So that also bodes well for the trends in the state if you look at the industry level, right?
Exactly, because the service sector should naturally recover as we sort of recover from the pandemic over the next year. So it's good to see that the industries that are most important to New Jersey are really thriving to some extent, and then the service recovery should just sort of come with time and lower cases.
Cool. So there's one more chart and then a conclusion slide, and then if there's any time left, we'll take any questions. This is like this next chart you can file in the category of like things you don't need Andy and Stephanie to tell you, but it's something that we look at JPMorgan. You remember this one?
Yeah. So here we're showing the funding ratio by state. So outside of, I believe it's Illinois, New Jersey comes in sort of a second to the worst. But you have seen it get a little better over the past couple of years. So some of the changes in terms of benefit terms have helped. But it certainly is a challenge for the state that I'm sure everyone here is largely aware of.
So Stephanie, let's try to put like a bow around this broader conversation, and then we'll take any questions. I'll let you wrap first with these key risks, and then some final takeaways.
Yeah, so I would say that the first risk is that inflation doesn't slow down. That's something that is really important to our outlook, in particular because it's impacting companies from a wage perspective. It also impacts the Federal Reserve because they have to pay attention to inflation because that dictates when they're going to be raising interest rates. Our base case is that they're going to raise interest rates at the end of 2022, and that's an outlook that's actually allowing them to be a little bit more patient. The market thinks they're going to actually hike rates a little bit earlier than that. So we think inflation should slow down. The Fed could wait until the end of 2022. But if we're wrong on that, the outlook could look a little bit more challenging for next year. The second one would be a new COVID variant that is vaccine resistant. We actually wrote this before we heard any,
right.
before we had any details. But I have to say that is certainly probably one of the biggest risks out there. Just because with the Delta variant, because it was still working well with the vaccines, it didn't impact the economy all that much. But if something is really vaccine resistant, that might result in another period of sort of much slower growth until we get a new vaccine out there. Sure.
One bit of insight so far from JPMorgan on the Omicron, I don't know if I'm saying it properly, variant though, and this again comes from a gentleman by the name of Michael Semblist. By the way, if you Google JPMorgan COVID private bank, you'll get his whole landing page. Jamie Dimon tapped him to be our COVID czar. One of the things that people are alarmed by is you see this big spike in South Africa in cases all of a sudden, and those are almost entirely attributable to this new variant. What he's finding after digging into it is it looks more like a data dump where they're collecting data, they're doing genetic sequencing on the virus, and all at once dumped all this data, into the, the record books that said we identified all these new variants over the last couple weeks, and so the spread, that big spike, wasn't necessarily organic, meaning you've actually seen this variant kind of festering around in the country for a little bit, and then the spike is reminiscent more of like this data dump than the thing. If that's true, then it means that it's spreading less quickly than what originally caught our attention, which would probably be good news. So just something to think about. Keep your eye on that portal.
Exactly. In the next 2 weeks, we should learn a lot more. So that's going to be really crucial just to get a sense of real-world implications outside of Africa in particular. So it's certainly a big unknown right now. Maybe the last risk to highlight would be the China risk. China growth has slowed quite a bit over the past year. They've tightened policy. They're trying to reduce their housing bubble. That's been an issue for them for many years. As of now, we think that they'll sort of manage a modest slowdown, but the risk is always there that they sort of do too much. Yeah, they make a policy mistake. They do too much too fast, and that impacts the global economy.
So summing this all up, our private bank outlook hits the shelves basically this week. Can you give me 90 seconds on 2022? What's the outlook? But broadly speaking, kind of risk on versus risk off, where are we? And then we'll take any questions in the last minute or two.
Yeah, sure. So stocks over bonds for sure. We think it's a risk-on environment. We think 4.4% GDP growth for next year, which is a really healthy clip. We think inflation should slow for all the reasons that we just talked about, which would be really important, not just from a business perspective, but also for the Federal Reserve, like I mentioned earlier. That should be a good environment for risk assets, especially if the Fed is actually able to be more patient than the market expects. So that would be really important from a risk perspective. We do think we're in mid-cycle. So what that means is we're not in early cycle where returns are incredibly high and the market just all sort of moves together. So we think it's a more sort of normal environment for investing. We shouldn't expect another 25% return year. That's not a normal type of year for the equity market, so think more single digits. But that's a very healthy clip, but it would certainly suggest stocks over bonds. We think rates are going to head higher. A little over 2% is our outlook. So it should be a good year for risk assets, good year for the economy, and we want to see that inflation slow down.
Wonderful. Well, the clock says 44 seconds left. Do you mind if should we take one question? One or two? Over here. Yep.
Just curious about how much of a risk you think these are. For Bill Powell, from the Carter firm. Just curious, you saw Chairman Powell's statement yesterday, and he and Secretary Yellen are testifying on the Hill today. But his statement yesterday seemed to be particularly cautionary. He seemed to have a great change of tone, talking about the supply chain and employment picture may be really impacted by the new variant. So it seems like that risk level on inflation and new COVID and the Fed being hawkish, suddenly seems to be very much spiked up. And also too, comment. I think you mentioned the new infrastructure bill that was passed by Congress and the President signed. And you think that's how much of a boost to the economy you think that is?
Sure. Just to restate the question real briefly. First, Fed Chair Powell struck a more cautionary tone in his statement yesterday, especially related to the new COVID variant. And then second question, the infrastructure bill. I'll give that to Stephanie.
Yeah, so on Fed Chair Powell being a little bit more cautious, we sort of agree, and that's one reason why we've expected that the Fed will be more patient than maybe the market expects in terms of raising rates, just because the pandemic's not over. There's a ton of uncertainty, and the inflation dynamics have yet to settle down. So that cautionary tone certainly makes sense in this environment. We don't think that they're going to be in a rush to hike interest rates, especially with an economy that's still recovering and the employment picture is very much unclear. We expect that these people will come back to work. Powell has said that before as well, but I think we need to see it. And I think it will be really important to see in the next 3 to 6 months whether those people actually come back to work, because the employment side of their mandate is really, really important right now, and Powell has emphasized that. So I would say, makes sense that the Fed is striking a more cautious tone on it, and they'll have to sort of see. But at the margin, it suggests that they'll be a little bit more patient than they otherwise would be. As for the infrastructure bill, the bill that was already passed, it's really important. It's going to be great because there's much needed infrastructure, very much aging in this economy. It's a slow rollout, so the impact on GDP is not that large, say 20 basis points a year, but there certainly is a tremendous need for it. And then we'll have to see what happens on the next infrastructure bill. That one is certainly larger, would have a more significant impact on the economy, but that also does come with some tax increases. So there's sort of a balance there.
Yeah, the physical infrastructure bill is like a big, the headline is like a big dollop of peanut butter, but that thing's got to get spread across the whole country and over a long period of time. So the immediate impact on GDP, pretty small. We're out of time, but I really appreciate you having us here. And if there's anything we can do for you, we're happy to hang out for a couple minutes. You're welcome to get in touch. But hopefully there was something useful in there for you to think about. Thank you so much.
Thank you.
Thank you.